clear. But now on to the big debate of the day on the Reserve Bank of India's action, or rather inaction, on interest rates.
Maybe some rise in inflation over the next couple of months. Essentially what this is doing is validating our projection that the trend is now softening. And based on that, our guidance given in October has been reinforced.
My own sense between CRR and repo was that a repo cut would have been happier, because already they have cut CRR quite significantly, and repo rates might bring down systemic rates over a period of time.
I think, the RBI has shown itself to be, in my opinion, the worst central bank. Is certainly in India's memory, and in a comparative study, the worst central bank as far as managing monetary policy is concerned.
I don't want to comment on whether the RBI should have done more or not. We leave it to them. But we are certainly engaged in putting in place a package of measures which would bring about a revival of investment. Probably it's true that at the moment, the need for funds is not the binding constraint. The binding constraint is getting rid of many implementation problems.
The Reserve Bank of India today left benchmark rates unchanged, reiterating though in its guidance that a rate cut could be coming in the January policy. But will 6 weeks change anything materially, and should the Reserve Bank of India have played along with the government, which has after all begun the process of getting its house in order through a slew of fiscal side measures recently? That's our debate tonight, and joining me on the show is Mr. D.K. Joshi, senior economist at Crisil, from from Mumbai, and Sheshadri, the executive director of the Bank of India, also joins us from Mumbai. From Kolkata joining us is Mr. Sunil Kanoria of Shrey Infrastructure. He's also the vice president of ASSOCHAM. And from our New Delhi studios joining us is Mr. Rohtash Mal, a veteran industry leader. But before we begin our debate, a quick analysis of today's credit policy from our financial policy editor, Ira Dugal.
The Reserve Bank of India's mid-quarter policy came as a slight disappointment to some people who were starting to expect at least a CRR cut, if not a repo rate cut. Let me start with the headlines, and then we'll talk about what the RBI is guiding towards. The headline, of course, was that key rates have been left unchanged. The repo rate stands at 8%. The CRR remains unchanged at 4.25% as well. Let me just step back. The reason expectations had built up in the last few days or so is because we've had two inflation prints which were softer than what the RBI would have seen, what the markets were expecting as well. And also you had core inflation coming to well below 5%. So the expectation was that maybe the RBI would be comfortable in bringing forward its rate action, but they weren't. So they left rates unchanged, but they've guided towards rate action in January, which is exactly what they've done in October as well. In the guidance issued today, they say in view of inflation ebbing, monetary policy has to increasingly shift focus and respond to the threats to growth from this point onwards. The only difference between the October guidance and this guidance is these three words, this point onwards, which probably leads you to believe that the January rate cut, if it happens, will not be a one-off rate cut. It will probably be followed up by more rate action on the downside as well. They also, in their guidance, talk about reinforcing the October stance, where they had said that there would be possible rate action coming in January. That's in the fourth quarter of the fiscal. They reiterate that. But they, of course, not taking their eyes off inflation entirely. They say that risks to inflation remain. So even as the policy emphasis shift towards growth, the policy stance will remain sensitive to these risks. So basically they're saying that if inflation surprises to the upside for one reason or the other, the RBI would have to keep that in mind. The economic outlook coming out from the RBI is more or less unchanged compared to their last policy. GDP growth, they say, is evolving around the baseline projection of about 5.8% growth. They acknowledge that recent measures taken by the government should help sentiment and they should also help investment down the road. As far as inflation is concerned, they talk about the fact that excess capacity in the system is helping bring down core inflation. That's good news for the RBI. And of course, if lower commodity prices remain on the global side, then that should help the headline inflation, unless, of course, a weaker rupee offsets the benefit of those lower commodity prices. So I guess the question to ask now is what lies ahead. Let me start with the liquidity side, because remember, the RBI did not touch CRR, even though liquidity has been tight. So the expectation in the market is that they would continue with open market operations in the coming weeks. As far as rate action is concerned, January rate action looks like more or less a given, unless there's some horribly negative surprise on the inflation side. But it may not be a one-off. And I think that's where the expectations have changed, that maybe this would be a series of small baby step rate cuts that would come in. 75 to 100 basis points is what most people are now expecting through next year.
All right, with that, let's open the debate with our panelists. I want to come to you, Mr. Joshi, first. Your first reactions on what the Reserve Bank of India has done are pretty much in line with expectations, but there was some hope of possibly a surprise move from the RBI, and that hasn't come through.
Well, I think we were expecting RBI to maintain the status quo, and I think that was the predominant view in the market as well. I think the central bank is more or less given a guidance that the probability of rate cut is now rising, and it is likely to happen in the first quarter of next year. I think there are a couple of pointers towards that. One, the growth in the economy is weak, that everybody understands. The second pointer is that inflation has started coming down, though it is not to the comfort level of the central bank, but it is definitely coming down, and the core inflation, more importantly, is down to 4.5%. So it's not a one-off reduction in core inflation, which is regarded as a measure of demand pressure in the economy. I think that coming down on a consistent basis in the last 3 months, I think is giving assurance that we are probably going to see a rate cut in the first quarter of next year. And I think as far as the revival in the economy is concerned, we all know that the growth is weak because of domestic factors as well as due to global factors, and interest rate is only one of them which is contributing to that. And I think the policy environment which has started improving, I think needs to go further on that. We need more implementation. I think that will create a more conducive environment for the economy to lift. And I think the fiscal angle also is there. Fiscal deficits have been high and have contributed to inflation in India in the past. And I think the resolve to bring the fiscal deficits down is also creating space for the central bank to cut rates. So all pointers are that the rates are going to come down early next year.
Right. Mr. Kanoria, from an industry point of view, this is definitely a dampener. Are you disappointed? ASSOCHAM, of course, has been lobbying for a rate cut because, talking really from a point of view of inflation, like Mr. Joshi did mention, it is coming down, core inflation is coming down, then why really wait for another 6 weeks?
Yeah, I completely agree with you. Although it is not a surprise what has happened today, it was known that and expected that RBI would not reduce interest rates at this juncture and wait for the new year. Maybe it's a new year gift they may look at. But basically the point from the industry, I think, is it's important that although we know that interest is not the only factor, but one thing very clearly, interest, especially for the infrastructure sector, is very critical and the most important component apart from whatever the implementation problems are there on the ground which the government has to address. Even if a lot of those issues is addressed on the project side by the government, if interest rates are high, infrastructure development cannot happen by the private sector.
So, but
that is very clear, because even 1% increase in interest rates has a major impact on infrastructure projects.
So what would a cursory 25 basis points repo rate action or a CRR action would really have done on the ground? Would that have substantially changed things as far as restarting the investment cycle is concerned? And given, of course, that CPI inflation continues to remain high, then, the other argument could be that, yes, probably it was right for the RBI to wait for some more time. Mr. Kanoria?
Well, it's a debatable thing, but as I feel that at this juncture, India needs investment. And for investment, apart from whatever the government action on reforms and policies have to be done, I do not undermine that at all. But interest rate cut is required. I don't see a CRR or SLR cut or a repo change happening to make a major impact in the investment. That is basically to cater to the short-term liquidity situation, which may be challenging for short-term time, and to address that issue on liquidity. But basically, I think very clear, India needs a lower interest rate regime in order to augment investment and bring in the required impetus to new investments.
Mr. Rohtash Mal, would you agree with the RBI's rationale of pushing the interest rate cut possibly to Jan to wait for another 6 weeks? Is that materially going to be changing anything on the ground at all?
I'm personally quite comfortable with what has happened today. I'm not so confident that any interventions at this stage will do anything to give a spurt to the economy via the monetary issues that we are hoping to address. Clearly, tinkering with this today or otherwise, it's like assuming that if you throw money at the problem will go away. I don't see that happening. What I do see happening is that, okay, let me put it like this. There are two angles from which one can view interest rates, from the angle of an investor or that of a consumer. I don't see a situation that 0.5% here or 0.25% here, with due regard to infrastructure projects and so on, where viability is important, very important and sensitive to interest rates. I don't see investment decisions going to happen because you cut rate by 0.25% or 0.5%. By the same token, I don't see myself or any other consumer buying a new car because you cut the rate by 0.25%, 0.5%. You want me to go buy a new car, I need to be sure that my food inflation is under control, the fact that I am able to create surpluses, with future surpluses, with which I pay for my investment. So clearly, we are seeing the problem from the point of view that if you throw money at the problem, it will go away. I would urge the government, and that has started happening in the recent couple of weeks, some decidedly determined measures to take care of a few problems in the economy, policy measures, etc., so as to kickstart consumption and therefore kickstart investments. So that's my point of view on, and I personally see this entire debate of the credit policy really month on month as storm in a teacup. Look at it one more way. Take the CRR. The CRR has been over the last 14 months reduced from 6% to 4.5 or thereabouts. We are looking at a 25% swing in the CRR, right? What has that done to our economy? So in the absence of persistent policy, persistent governance, determined to set right what's gone wrong in the past couple of years, I would see these as tokenisms of...
Right. You know, I want to pick up on a couple of those points later on the show, sir, but I want to get a banking story, really perspective right now. Mr. Seshadri, are you disappointed? Were you at least hoping for a CRR action? And really, what does this mean in terms of bank rates? Does this give you any scope at all for a reduction, at least in those sort of segmental categories which banks have been pretty active in?
See, frankly, the signals are very clear, and definitely the whole policy statement, if you see which way the interest rates move, has been very clear, and the Reserve Bank of India is genuinely interested in growth, and they are also concerned about inflation, which has moderated a bit actually, and they would like to see that what steps they take, in fact, they are all steps in the right direction. Having said that, a reduction of 25 basis point or 50 basis point, and just to only 6 weeks ahead of the next policy schedule, is not going to make any material difference in terms of investment decisions, but it might send some sort of a signal, more of a perception where people said, in fact, I am back on the interest rate upper movement, and then I can look to it also. But on some of the segments, on retail, on some of the SMEs, in fact, where they have been postponing capex, probably, in fact, it might make a bit of a perception. And even if they had reduced, in fact, the repo rate, or even if there's a CRR, it will be taking a little while before, in fact, people start looking at the investment decisions. We have started, in fact, looking to take a cue on the Reserve Bank in terms of reverse movement in interest, probably in some segments where we need to kickstart, we need to basically see that, in fact, the great growth happens. We will definitely look to, on a selective basis, reduce interest rates. We have done in the past in terms of some of the retail loans, and we'll look to it. Because it is very clear from the stance that growth is critical. We need to have a sustained growth, and interest rate definitely, in fact, would not be an improvement in terms of growth. I think this is exactly what we get from the RBI stance.
Mr. Seshadri, in fact, I want to stay with you. This whole signal from the Reserve Bank of India that the central bank may cut rates in the upcoming policy in January, could that in some sense give an impetus to credit growth purely on the basis of sentiment?
Yes, in fact, a part of sentiment definitely would be required, and more importantly, the moment in fact you start reversal of interest rate, that is where exactly people would look to, in fact, doing some capex, and some of those segments like retail, some segments in fact on housing, and probably the SMEs which do have a very great amount of interest rate sensitivity in their whole working. I think they would start looking to those signals. And I do agree that in fact there is a lot amount of policy and supply issues which are all critical, but I think sending a right signal in terms of interest rate is also critical for some of these. It may not affect large infrastructure projects materially, but it definitely will affect many of actually the mid segment and mid corporate segments in terms of expanding their credit.
All right, I want to get Mr. Kanoria in fact, in some of the points that Mr. Rohtash Mal made. So, let's talk really about the sort of structural problems in the economy and whether an interest rate really would have been able to solve that. I mean, you have the government which has acted on the fiscal front, but has it really sort of addressed the structural issues when it comes to inflation, when it comes to really this whole supply chain issues that we've all been speaking about? And if that's not been addressed, then is inflation going to be a constraining factor for interest rates in the next year as well?
See, I firmly believe that yes, there's very clearly there's no shortcut to resolving the issues which are plaguing in terms of the reforms, in terms of the implementation of project, the challenges, whether it is land acquisition, environment, etc. Those things need to be addressed, no doubt about it. But on the interest rate front, if we really look at the structural change which India has had in the last 8 to 10 years, major investment in India has happened in the infrastructure sector by the private sector. And there it is very, very susceptible to high interest rates. You cannot have a road project where you have such high interest rates, because the burden then comes on the tolling and to the consumer directly. Again, it is inflation oriented. And if you have roads, you will start to improve the supply side constraints which are there in the economy. So we have to go through some pain in the short run if we have to get some gain in the long term. We need to ensure that yes, growth is important, inflation has to be checked, but not at the cost which will not help us to survive on the long term.
In fact, let's pick up on that. I want to take that to Mr. Joshi, sir. I want to take that to Mr. Joshi. What really do you think, sir, does the Reserve Bank of India expect from the government in terms of, tighter fiscal reform? We've, of course, had a slew of reforms on the FDI front, on NIB and so on. But in the immediate term, what really do you think would sort of reinforce the confidence of the Reserve Bank of India and, them, starting to talk in the same tone as the government as far as growth is concerned?
Well, I think both the monetary and the fiscal policy have to work in coordination. I think central bank in its October policy had talked about that. I think what it simply means is that government has to cut its fiscal deficit. It has to move its expenditure from consumption expenditure towards investment expenditure, because too much of consumption spending has also been behind inflation, and I think that rebalancing of expenditure needs to be done. So which means cutting subsidies, etc. And part of it government has already started. I mean, they have raised the diesel prices, which is a part of cutting subsidies. They have also initiated some reforms in the way the subsidies will be dispensed. I think all those will take time, but I think overall a restructuring is required, because when you have too much of consumption demand and too little of investment demand, it generates inflationary pressures, and that's what we have seen. So I think to reverse that, a mix of expenditure in government needs to be changed, and at the same time you need supportive policies for promoting investment, and that's also happening. I think that's happening in terms of National Investment Board. It is happening in terms of willingness to push ahead the land acquisition bill. I think all these things will create investment capacity in the system. I think finally I just also want to say that we need to focus on agriculture, because one of the reasons why inflation has been so persistent, particularly in agriculture, is because we have created demand for food items, but we haven't created enough supply. So I think rekindling Indian agriculture will be very critical from the policy side. So I think what we need is, in short, is a very credible fiscal consolidation program which lays out how the restructuring of expenditure is going to take place, and at the same time we need more supportive policies for investment.
Mr. Rohtashmal, this whole point that Mr. Joshi was making about shifting from expenditure to investment, how much of that is really going to be palatable and possible in what's going to be a year of an election, politically speaking?
Okay, if I might, Nikhil, adapt your question to your earlier one and then address this one. You asked for initiatives of a kind that will have a quick impact, and clearly those are not even policy-led. They don't need to go to Parliament. One of them do. But let's just pick up two. Direct impact on inflation and a direct impact on our GDP. Number one, look at the manner in which our food moves. So amendments to the APMC Act, and I'm just picking up a thread from the point that was made regarding agriculture. Amendments to the APMC Act, the implementation of the APMC Act, the movement of foodstuffs and food grains, and as indeed fruits and vegetables without hindrance across the country. Now that cleaning up itself is going to have a salutary effect on inflation. The moment you get hold of inflation, at least on the food front, you are actually injecting a dose of confidence into the consumer and saying, this is under control. Now you can dream what you want to do about your economic surpluses at an individual P&L level. Let's pick up the other one that's been hanging fire because of partisanship in our politics, the GST issue. GST has a direct impact, and we can debate about its total overall impact, but it's a quantum impact. And the quantum shift in our GDP by various pundits is between what, 20 and 30% swing in the GDP by merely debottlenecking all these taxes and so on. Clearly stuff in the hands of the government to look after. It doesn't need monetary policy, it doesn't need interest rates, it doesn't need all these, let's hope to do this and let's have this effect kind of syndrome. And to your next question, Nikhil, which was?
So basically my question to you really was, in a politically sensitive year, what's going to be possible in terms of shifting from expenditure into investment, because that in some sense is also going to be the structural reform that we're going to be needing, like you said.
Look, that is the way I would desire it to be moved. That is the way I'd feel that ought to go. Realistically speaking, the manner in which we are seeing our politicians performing, the manner in which we see the quality of debate in Parliament and outside Parliament, the partisanship which is renting aside what ought to be good decision making, doesn't give me very much room for comfort on that score. So in a manner through this, what I am appealing to the powers that be is, for God's sake, focus down on what's real, what needs to be done, and let's get on with it in repairing what we ourselves have damaged.
Right. I want to get in Mr. Kanoria because he has to leave us, I believe. So just want you to sort of crystal ball gaze on where you see rates in the January policy, where you see really interest rates panning out in FY14 as well, and what would your projection be as far as inflation is concerned?
Well, I think by January we should see the RBI bringing down some rate cut. That's the expectation, which would be also essential for the economy to again swing back. And hopefully by then many of the bills which and the reform which the government is working on would get approved shortly. So I think it would help the sector, help the economy. And if we look at a one-year horizon, I think we should see a 1% reduction in the interest rates in the next 1 year or so.
Mr. Sheshadri, the same question to you. Interest rates in the next 1 year, and especially in the January policy, do we see a sort of big bang 50 basis point sort of a thing to kickstart the new year possibly?
While it will be reasonable to expect a 50 basis point rate cut in the January policy, I would see some challenges coming in, largely on account of if the fiscal deficit, in fact, if fiscal deficit is not managed well, and if the commodity price start moving, in fact, you will see some amount of inflation again coming in the way of further rate cuts. There could be a moderation in interest rate a little while, but my only concern is if again inflation comes in the way, then you would not be able to see, in fact, anything beyond further 25 basis point. I would say for the whole year, commencing January till maybe December or March, about 75 basis point is the most optimistic rate cut we can expect. But 50 basis point cut, and I would go with it in January. But we'll have to look to see how the inflation basically fans and how the commodity prices basically behave, especially the fiscal deficit, in fact, that the government need to really do. And in an election year, that is going to be the biggest challenge.
Right. Finally to you, Mr. Joshi, any sort of unforeseen factors that you could see springing a negative surprise as far as the inflation numbers concerned and the collateral damage of that on interest rates in the next 1 year or so?
Well, I think one shock which could be from the global crude prices. India is highly sensitive to what happens to global crude prices. We import a lot of them. These the petroleum products in the domestic economy are subsidized, so it has a fiscal impact. So I think one of the key variables to watch out as far as the pressure on inflation is concerned is the crude, what happens to global crude prices. And I think on the other pressures on inflation are, I think one could be, if you get a bad monsoon, I think that would again make the food inflation, which is persistent, which it will push it up even further. I think the third factor which could cause inflation is, I think, which anyway I think we are all factoring in when we make our forecast for the next year is the increase in utility prices. The electricity prices had been suppressed for quite a while, and I think for the next 4 to 5 years we should see continuous increase in them. So that is something that is given. But the surprise could come from the global crude prices and also from the monsoons if they don't turn out well.
All right, so on that note, we will have to wrap up the discussion, completely out of time, but all eyes really now would be on what next. The fact the RBI would move on rates in January is pretty much been factored in, but by how much and for how long really is the big question. A big thank you to all my guests and thanks for watching We Mean Business. But coming up on the other side, an exclusive chat with the World Bank Chief Economist, Kaushik Basu.